Welcome back, my awesome people. In today's episode, I will be highlighting the cryptocurrency scams that have been wreaking havoc on the crypto market the past couple of years. From pump and dump coins by influencers to the manipulation of crypto prices by retail and institutional investors. I am sure my loyal subscribers have noticed that I have always been against cryptocurrency, especially the ones that serve no purpose or utility. And now I am starting to have a positive outlook on those crypto coins that actually have usage and utility. As recently, I have been adding crypto to my portfolio, specifically Ethereum, due to its practicality and usage. And I'm not buying Ethereum coins specifically, I am buying them through an ETF, through the Purpose Ethereum Yield ETF. And you can check out my video in which I went through in detail of why I am investing in this ETF and why I am investing in crypto through this ETF. And if you want to know why I do not invest in Bitcoin or the other alternative coins, check out my two videos. And hopefully it will break down why Bitcoin is not as practical as Ethereum. So, my awesome people, most cryptocurrency is a scam. Yes, it is. Not just the latest pump and dump shitcoin schemes in which fraudsters hype up a little known cryptocurrency before dumping it, or rug pulls in which a new cryptocurrency's developer abandons the project and runs off with investors' funds. As such, cryptocurrency and the industry as a whole are built on top of market manipulation, without which they could not exist at scale. This should surprise no one who understands how cryptocurrency works. Blockchains are, at their core, simply spreadsheets maintained across decentralized peer-to-peer networks, like those used for torrenting pirated files. Just as torrents allow users to share files directly, cryptocurrency blockchains allow users to maintain a shared ledger of financial transactions without the need of a central server or managing authority. Users are thus able to make direct online transactions with one another as if they were trading cash. Cryptocurrency blockchains generally don't allow previously verified transactions to be deleted or altered. Updates are added by chaining a new block of transaction data to the chain of existing blocks. But to ensure the integrity of the blockchain, the network needs a way to trust that new blocks are accurate. Popular cryptocurrencies like Bitcoin and Ethereum employ a proof of work consensus method for verifying updates to the blockchain. Without getting overly technical, this mechanism allows blockchain users, known as miners, to compete for the right to verify and add the next block by being the first to solve an incredibly complex math puzzle. The point of this process is to make adding new blocks so difficult that meddling with the blockchain is going to be expensive. Though the correct answer to these puzzles can be easily verified by anyone on the network, actually being the first to find the answer requires an enormous amount of processing power and electricity. So for their troubles, miners collect a reward for being the first to verify the next block. The Bitcoin blockchain adds a new block every 10 minutes, and the block reward is currently 6.25 newly minted Bitcoins, worth about $500,000 at Bitcoin's last all-time high. Competition for block rewards has led to a computing power arms race as prices have risen. Mining Bitcoins on a personal computer is no longer feasible. The majority of cryptocurrency mining is now conducted in commercial mining farms, essentially huge warehouses running thousands of high-powered computer processing day and night. The electricity expended mining Bitcoin and other cryptocurrencies is rapidly approaching 1% of the global usage, which is famously greater than the total electricity consumption of many smaller developed nations. Given that cryptocurrencies don't produce anything of material value, this enormous waste of resources renders the whole enterprise a negative sum gain. Investors can only cash out by selling their coins to other investors, but only after the miners and various cryptocurrency service providers take their cut. In other words, investors cannot cash out for even what they put in, as cryptocurrencies are inefficient by design. So this makes them a poor and costly form of currency and absolutely ludicrous as a long-term investment. We could dismiss them as a doomed experiment in the greater fool theory of investing, in which investors attempt to profit on overvalued or even worthless assets by selling them on to the next greater fool. And with barely any regulations or standards for cryptocurrencies, price manipulation plays as much or more of a role than demand in driving prices higher. And for more strategies and tips on money, investing, and financial independence, follow me on my Twitter at Jacob Rant, and get bullish on that subscribe button and smash all the likes and bells to get all the updates on my many fantastic investments. And comment below with what cryptocurrencies you currently own. And if you are watching this video and do not have a Wealthsimple trade account and you want free money to trade with that won't eat into your profits, especially if you're buying penny stocks, sign up with my Wealthsimple trade account in the description box below. So you will get $25 of free real money to trade with. Link is below. Now, there has been plenty of talk about a central bank of crypto, and this isn't some big secret. For example, in a widely circulated 2017 article, I have posted the link to this article below, researchers have connected that over half of the rise in Bitcoin's price were made by purchases by a single entity. These purchases were timed to manipulate the price of Bitcoin during market downturns in a way that so strongly indicated market manipulation. These purchases were not made with dollars, but with Tether, which is another type of cryptocurrency known as a stablecoin, because its price is pegged to the dollar. So that one Tether is always worth $1. Many cryptocurrency exchanges lack access to traditional banking, presumably because banks deem doing business with them too risky. Without traditional banking relationships for issuing wire transfers, exchanges cannot easily facilitate trades between buyers and sellers on their platforms, and stablecoins solves this problem by standing in for actual real dollars. Tether has become integral to the functioning of global crypto markets. The majority of Bitcoin trades are now conducted in Tether. Many industry skeptics and even proponents see this as a systemic risk and ticking time bomb. Should faith in Tether fall, we could see its peg to the dollar collapse in a flash. And this will be a doomsday scenario for crypto markets, with investors holding or trading crypto assets or unbanked exchanges unable to cash out, since there was never any cash there to begin with. Only stable coins. So this would almost certainly cause a liquidity crisis on banked exchanges as well, as investors rush to cash out their crypto anywhere possible. Ultimately, there is no reason to have any faith in Tether. Tether's peg to the dollar was initially predicated on the claim that the digital currency was fully backed by actual cash reserves, which are dollars held in reserves for every Tether issued. And that was later shown to be a lie. There is no reason why cryptocurrency exchanges should need an exponentially expanding supply of stablecoins to facilitate daily trading. The explosion in stablecoins and the suspicious timing of market buys outlined in a 2019 class action lawsuit, which again I have also linked below, alleges that tethers are being printed from thin air and used to buy up Bitcoin and other cryptocurrencies in order to create artificial scarcity and drive prices higher. As a result, Tether has become some sort of central bank of crypto. Like central banks, they ensure liquidity in the market and even engaging in buying up financial assets in order to stimulate the economy and stabilize financial markets. The difference is that central banks, at least in theory, operate in the public good and try to maintain healthy levels of inflation and encourage capital investing. Whereas private companies issuing stablecoins are inflating cryptocurrency prices so that they can be dumped on unsuspecting investors. And unfortunately, this makes cryptocurrency not merely a bad investment or speculative bubble, but something more closer to a decentralized Ponzi scheme. New investors are being lured in under the pretense that speculation is driving prices when market manipulation is actually doing the heavy lifting. But this can't go on forever. Unbacked stablecoins can and are being used to inflate the latest trading price of cryptocurrencies to levels totally disconnected from reality. But the electricity cost of running and securing blockchains is very real. If cryptocurrency markets cannot keep luring in enough new money to cover the growing cost of mining, the scheme will become unworkable and financially insolvent. That money will be gone forever, having been converted to carbon and released into the atmosphere, making cryptocurrencies even worse than traditional Ponzi schemes. While a few listed companies, most notably Tesla and MicroStrategy, have taken multi-billion-dollar gambles on cryptocurrency with company money, of course, most of these companies are simply offering transactional services rather than investing into cryptocurrencies themselves. Even MicroStrategy, though initially spending $250 million in company money on Bitcoin back in August of 2020, proceeded to raise billions and billions more in repeated rounds of fundraising. The only real solution is to ban the trade of private cryptocurrencies entirely. This would, of course, kill off cryptocurrency almost entirely. China already banned cryptocurrencies entirely, and India and Pakistan are poised to do the same. Other countries have also made moves to prohibit or constrain cryptocurrencies. Well, Jacob Rant, now that you are invested in crypto, what are your next moves? Well, my awesome people, the 2008 financial crisis made clear why the financial sector must be brought under public control. Cryptocurrency and decentralized finance aren't special. They are simply just more of the same privatization and deregulation masquerading as high-tech solutions. Unregulated, privatized financial markets pose the same risk to the public, whether they are or not on the blockchain. In the case of cryptocurrency, regulation is an existential risk precisely because regulatory loopholes and fraud are the only reason the industry appears profitable despite being a waste of energy resources. The longer governments take to ban them, the worse normal people will be hurt. Fortunately, there are alternatives to buying the actual coins and avoiding all the unnecessary hassles and fees. Instead, why not buy a crypto ETF that holds your preferred coin? And that is what I have been doing and will continue to do so. I will not be buying actual coins. Instead, I will be buying crypto through ETFs. I am a big supporter of Ethereum and have been heavily invested in Purpose's Ethereum Yield ETF, ticker symbol ETHY, where the ETF holds only Ethereum in cold storage and has an incredible distribution yield of 25+%. A distribution yield of 25+%. This is my only crypto investment so far, as I am able to buy this ETF into my tax-free account and enjoy the tax-free growth, monthly distributions, and exposure to the crypto market safely and securely. But remember, my awesome people, just like all the investments I mentioned in my videos, please do your own due diligence because I am just a clown on YouTube. And again, if you are watching this video and do not have a Wealthsimple trade account and you want free money to trade with at $0 commission fees that won't eat into your profits, sign up with my Wealthsimple link down in the description box below for $25 of free real money to trade with. Link is below. So again, I am not a financial advisor, so make sure you do your own research and consult your own financial professional. Thanks. There is so much wealth out there for all of us to get a piece of. So by allowing our hard-earned money make us more money is the key to wealth and the key to financial success. Subscribe, like, and share to help out the channel, and so you will get notified of when I post my penny stocks, REITs, dividend, and speculative stocks from my portfolio and other investments I am currently buying and selling. I want everyone to have the opportunity to get out of this work-life trap by buying back their freedom through investing. So let's all ride together on a journey of health, love, success. So until the next video, stay ranting.